You've been carrying a credit card you haven't touched in over a year. Maybe it's from a store you stopped shopping at. Maybe it's from a bank you moved away from. It just sits in your wallet or your drawer doing nothing. And at some point you decide this is pointless. I don't use this, I don't need this. Having random credit floating around that I could theoretically spend feels irresponsible. So you call the number, close the account, and hang up feeling like you just did something smart. Then your credit score drops. Not because you missed a payment. Not because you ran up debts. Not because anyone on earth would look at your situation and say you did something reckless. You closed a card you weren't using. You removed risk from your life. The model decided you looked riskier. That's the contradiction this video is about, and it's not a glitch, it's not random, and once you understand the mechanics, it will never catch you off guard again. Before we get into why this happens, let's be honest about why people do it. Because the reasoning isn't stupid. It's actually pretty sensible. It just happens to be thinking in a completely different language than credit scoring. The most common reason is temptation. If the card doesn't exist, the spending can't happen. A lot of people have learned this the hard way. They opened cards, they used them, they carried balances that got uncomfortable, and closing the account feels like removing the weapon from the equation. That's real behavioral logic. It works in other areas of life. It makes complete sense as a personal finance instinct. Then there's simplicity. Managing multiple cards is genuinely annoying. Different due dates, different apps, different customer service lines, different reward structures with their own rules and expiration quirks. Getting rid of the ones you don't actively use feels like decluttering, like clearing out a closet. Mental overhead matters, and reducing it is a legitimate goal. Some people close cards because they assume an account they never use is worthless. If it's not doing anything, what's it doing for you? Seems like a neutral move at worst. And then there's the belief, and this is the one that causes the most real-world damage, that fewer credit cards makes them look better to a lender. Less open credit, less potential debt exposure, a cleaner profile. In normal human logic, that sounds right. In the actual mechanics of credit scoring, it often isn't. All of that logic makes complete sense in everyday life. The problem is that credit scoring is not everyday logic. It's a model built on specific data points, and the way it interprets your moves does not always match what those moves mean to a reasonable person. Here's the core of what's happening, and it's worth slowing down here because this is where most people lose the thread. Credit scoring models give significant weight to something called utilization, the percentage of your available credit that you're currently using. If you have $20,000 in total available credit across all your cards, and you're carrying $2,000 in balances, your utilization is 10%. That's solid. Scoring models reward that. The gap between what you could borrow and what you've actually borrowed reads as stability, breathing room, lower risk. Now here's the move that breaks the maths. You have two cards, each has a $10,000 limit. You're carrying $2,000 total, call it $1,000 on each. Total available credit, $20,000. Total balances, $2,000. Utilization, 10%. Good shape, you close one of them. You didn't spend anything new, didn't miss a payment. Nothing about your actual financial behavior changed. But your total available credit just dropped to $10,000. You're still carrying the same $2,000. Your utilization just jumped to 20%. You went from 10% to 20% by doing nothing except removing access to credit you weren't using. The borrower didn't become worse, the ratio did. And the model reads the ratio. This is why people think the score is broken. It isn't broken. It is just reading a different language than the one you were thinking in. You were thinking about risk exposure. The model was counting available credit versus outstanding balances. When you removed available credit and kept the balance constant, the ratio shifted, and the score followed the ratio. Now here's the part that catches people who already understood the utilization concept. Utilization isn't just measured across all your cards combined. It's also measured on each individual card. The model looks at both. So say you've got three cards, one with a $10,000 limit and zero balance, one with $5,000 and $1,500 on it, one with $3,000 and $500 on it. Overall, $20,000 available, $2,000 in balances, 10% utilization. Fine. But that middle card, $1,500 out of $5,000, is already showing 30% individual utilization. Not catastrophic, but notable. Now you close the zero balance card because you never use it. Overall utilization rises, but that middle card is still sitting at 30% on its own. You've made the overall picture worse, and you haven't improved a single individual card. The card you closed was quietly helping absorb the strain on everything else. You just didn't see it doing that job. That's the second layer. Closing a card doesn't just shrink your total credit pool. It can also spotlight the pressure on the cards that remain. The card you thought was doing nothing might have been covering for the ones you actually use. The impact of closing a card is not the same for everyone. Context changes how much it hurts. And some profiles get hit significantly harder than others. If you only have 2 credit cards and you close one, you've dramatically changed the structure of your file. You went from 2 cards to 1. Your available credit didn't just shrink, it got cut in half. Your utilization may have doubled. And if anything goes wrong with the remaining account, you have no backup profile to cushion the picture. This scenario carries the most scoring risk of any situation involving closing a card. If you're already carrying balances when you close a card, the utilization damage is sharpest right then, because your balance is already non-zero and you're reducing the denominator. If you had high balances and low utilization, that was because your available credit was providing room. Remove available credit with balances still in place, and you're taking the worst possible version of the ratio hit. If the card you're thinking about closing has a very large credit limit, say $15,000 or $20,000, and your other cards are much smaller, that one card might be responsible for most of your available credit buffer. Closing it doesn't just shrink the pool. It changes the fundamental structure of your utilization picture. If you're planning to apply for a mortgage, a car loan, a new card, or even an apartment with credit screening in the next 6 to 12 months, this is the worst possible time to close anything. Score volatility before a major application can directly affect your interest rate, and the card can be closed after the loan is done. And if the card you want to close happens to be your oldest account, the immediate utilization hit is the obvious problem. But there's another one coming, and it moves on a slower timeline. Let's make these profiles concrete, because abstract categories are easier to dismiss than real scenarios. Picture someone with 6 open cards, low balances across all of them, no plans to apply for credit in the next year, and they want to close a store card they opened 4 years ago to get a 20% discount and have used maybe twice since. In that situation, the available credit loss is small relative to the overall pool. The utilization impact is likely minor. The account age effect is cushioned by 5 other accounts. Closing this card may produce a small score dip, or possibly none at all. For this person, the decision is much lower stakes. Now picture someone with 2 cards, carrying $3,000 in combined balances, one of which has a $15,000 limit and one has a $5,000 limit. They want to close the $15,000 card because the annual fee went up. Closing that card removes $15,000 from their available credit. Their utilization jumps significantly. The remaining card now has to carry the entire weight of the profile. For this person, the scoring hit could be substantial, and it comes at the same moment their fee costs already felt painful. Now picture a third person who decides to clean up their finances 3 months before closing on a home. They close 2 cards they don't use, figuring a tidier profile looks better to mortgage underwriters. Their score drops just as a lender is about to pull their credit. On a 30-year mortgage, that score change could cost them a higher interest rate that adds real money to every monthly payment for years. The cleanup became the problems. Same basic action, closing an unused card, but 3 completely different outcomes depending on who's doing it and when. Now back to the long-term consequence that most people underestimate because it doesn't show up immediately. Closed positive accounts typically stay on your report for about 10 years before they age off. So in the short term, closing a card doesn't wipe your history. People hear this and feel reassured. That's exactly the trap. Because in 10 years, that account is gone. If it was your oldest account or one of your oldest, your average account age drops when it falls off. The length of your credit history is a real scoring factor. Older accounts with clean payment history anchor that average. Closing one today starts a timer you'll forget you set. You make the call in 2025. In 2035, that account ages off your report. Your average account age declines, your score adjusts. And you have no memory whatsoever that you made a decision a decade earlier that caused this. The consequence arrives without context, which makes it nearly impossible to learn from. This is the kind of consequence people ignore precisely because it doesn't hurt today. The delayed nature of the damage makes it feel theoretical. It isn't, it's just slow. Now let's be clear, not everyone who closes a card faces meaningful damage. The impact depends heavily on your starting position. If you have 6 or more cards and you're closing one with a relatively small limit and a short history, the utilization impact may be minor and the age consequence minimal. Your overall available credit barely changes. Your average account age barely moves. If your utilization is already very low, well below 10% across all cards, even a moderate jump from closing one card may still keep you in a range the model treats favorably. If you're not applying for any credit in the foreseeable future and your score is already in strong territory, a temporary or moderate dip may simply not matter enough to change your decision. If the card is newer, has a low limit, and doesn't represent much of your available credit, its strategic value to your profile may be limited enough that closing it is a reasonable trade-off. The point is not that closing a card is always wrong. The point is that closing one without understanding what you're changing is where people get into trouble. Here's where things get genuinely complicated, because there's a real tension at the center of this topic that deserves to be named plainly. Closing a card can be good for your financial behavior and not great for your credit score at the same time. These two things can both be true simultaneously. If having a particular card consistently leads to spending you regret, closing it and accepting a score impact might be the right call for your actual financial life. The score is not the only thing that matters. Sometimes your relationship with debt, your spending patterns, and your mental clarity around money matter more. This is not a situation where there's a clean universal answer. The real question is not close or keep. It's, what am I actually trading here, and is the trade worth it for me right now given what's coming in my financial life? Annual fees are a legitimate reason to act. But before you close, check whether the issuer offers a product change, converting the card to a no-fee version in the same product family. You keep the account open, keep the credit limit in your available total, keep the account history intact, and eliminate the fee. One phone call, if the option exists, it's almost always better than closing. Genuine behavioral problems are also a valid reason to act. If keeping the card means using it in ways that damage your actual financial situation, the score cost of closing it may be the better trade. You can rebuild a score over time. Debt you accumulated while trying to protect a score is a different kind of problem. Let's run through some of the questions people are actually thinking right now. What if I never use the card? Not using a card doesn't mean it's not helping you. If it's adding available credit to your pool, it's keeping your utilization lower than it would otherwise be. An unused card with a $10,000 limit is doing real work even if you haven't swiped it in 2 years. What if it has an annual fee? Run the numbers on closing versus downgrading first. If downgrading is available, do that. If it isn't and the fee is real and the card provides no value, closing may be the right call, just understand the scoring impact before you do it. What if I have 0 balances right now? This is the best time to close a card if you're going to close one, because the utilization impact is smallest when your balances are near 0. The available credit will shrink, but the ratio stays clean. That said, 0 balances don't make the move neutral. The card's credit limit still contributed to your available credit pool, the account still had age, and if you're closing soon before a major application or the card is one of your oldest, those factors don't disappear just because your balance happens to be 0 today. What if I want to simplify my finances? Legitimate goal. Just verify that the simplification is worth the scoring impact. Sometimes keeping a card open and ignoring it is the lowest effort option that preserves the most value. What if keeping it open makes me spend more? Then this is a behavior decision and you need to make it as one. Close the card, accept the impact, and deal with the score from a position of better financial habits. A score hit you chose knowingly is better than debt you didn't intend to carry. What if I'm about to apply for a mortgage? Wait, seriously, wait until after the mortgage closes. Score sensitivity in the months before a major application is real, and you should not be creating volatility during that window. What if it's a tiny store card with a low limit? Check the utilization math first. If it's only adding $500 to your available credit and you have $30,000 available elsewhere, the impact is minimal. If it represents a significant share of your total available credit, the calculation changes. While we're here, it's worth naming the most common mistakes people make in this situation, not because they're being reckless, but because the logic feels so reasonable in the moment. Closing a card right before applying for a mortgage is probably the most expensive one. The score drops, the timing is the worst it could be. The rate locked in reflects the lower score. People do this all the time because they want to present a cleaner financial picture. Not realizing the scoring impact from the closure can undermine exactly what they were trying to achieve. Closing the oldest card just because it isn't being used is another one. The card may not be generating rewards or even getting swiped, but its age is doing something real. Removing it starts the aging clock in a way that costs you later when you can't trace it back to the decision. Closing a fee card without first asking about a downgrade is probably the easiest mistake to avoid, and one of the most common. One phone call can convert the account to a no-fee version and preserve everything: the limit, the history, the age. People skip that call because they assume it isn't possible. Often it is. Closing while still carrying balances is where the utilization hit lands hardest. If you're going to close a card regardless, the right sequence is to get your balances down first, then close. Doing it in the opposite order is just making the math worse at the worst moment. There's one more thing worth understanding before you decide, and it's the part most people skip entirely. The model does not know why you closed the account. It doesn't see that you were trying to simplify. It doesn't register that you were acting out of discipline or trying to reduce temptation or being proactive about your financial life. There is no field in your credit report that says closed for responsible reasons. The system just sees that an account is no longer open, that your available credit changed, that your utilization shifted, and that your average account age may have moved. It updates accordingly. You can't explain your way to a better score. There's no appeal process where you describe your intentions and get the points back. The model processes what happened, not why it happened. Which means a thoughtful, well-reasoned decision can produce the exact same scoring outcome as a careless one, because the data looks identical either way. Understanding that isn't pessimistic, it's just the clearest possible reason to run the numbers before you act. Here's the practical way to think through this before you make the call. Start with the utilization math. Add up your current total available credit across all open cards. Add up your current balances. Calculate your current utilization percentage. Then remove the limit of the card you're thinking about closing and recalculate. If the new number stays below 10%, the impact will likely be modest. If it jumps meaningfully, that's worth factoring into your decision, especially with any major credit applications on the horizon. Then think about timing. Is there anything significant in the next 6 to 12 months that depends on your credit score? Mortgage, auto loan, new card, apartment lease. If yes, protect the score until after that event. The closure can wait, then consider the card's strategic value. How old is it? Does it carry a high limit that represents significant available credit? Is it one of the few accounts anchoring your credit age? The older and larger it is, the more it's contributing to your profile in ways that aren't always obvious. Then ask about the downgrade option. Before you close, call the issuer and ask if a product change is available. If it is, do that instead. You eliminate the fee and keep everything else intact. Then be honest about your real reason for closing. This part matters more than people admit. Are you trying to eliminate an annual fee? Are you trying to stop overspending? Are you trying to reduce mental complexity? Are you trying to improve your score? The right move is different depending on the actual goal. If the goal is the fee, explore the downgrade first. If the goal is behavior, make the call as a behavior decision and own the trade-off. If the goal is score improvement, closing a card is almost never the right path. Knowing what you're actually trying to solve changes what you should actually do. If you've worked through all of that and still want to close, pay your balances down as much as possible first. The lower your balances when the account closes, the smaller the utilization jump. Get your overall balances close to zero before the closure. That minimizes the ratio damage. Here's the close. Closing a credit card can absolutely be the right move. For behavior, for simplicity, for cost, for sanity, there are real situations where it makes sense and the trade-off is genuinely worth it. This is not a never close a card argument. That would be too simple, and too simple is usually wrong. But it is almost never a neutral move from a scoring standpoint. It changes utilization. It can change how individual cards look. It starts a long-term aging clock. And none of those effects ask for your permission or care about your reasoning. The mistake isn't closing the card. The mistake is closing it blind, without running the math, without checking whether a downgrade was possible, without thinking about what's coming in the next year, without knowing which part of your credit profile you were quietly weakening. People who get blindsided by a score drop after closing a card usually weren't being careless. They were trying to be responsible. They just didn't know the model would read the move differently than they intended it. Closing a card with full awareness of the trade-offs is a real financial decision. Closing it because it felt like the right thing to do without checking the numbers is just pressing a button blind and hoping the outcome is fine. Closing the card isn't automatically the mistake. Closing it without knowing what part of your profile you just weakened is.